There's a confluence of key trends that have unfolded thus far in 2021, like higher inflation. We've also got the outperformance of value stocks, and commodities have staged an impressive comeback. So what are these trends telling us about market conditions? And more importantly, what are the ETFs that benefit from these trends? Well, helping us to sort through that is my guest, Dave Mazza at Direction Investments. Stick around. I'm Ron DeLegge with ETF Guide TV. Welcome to the program. We've got a lot of ground to cover on today's show. We're going to get into some of the important investment themes and trends and give you the ETF tickers to play these trends. By the way, if it's your first time here, be sure to hit that subscribe button. That way you don't miss any of our fine programming. Also, post your comments below in the comments section. We love interacting with viewers like you. Without further ado, we're pleased to have with us Dave Mazza, Head of Product at Direction Investments. Dave, welcome back. It's always great to see you.
Hey, thanks for having me back. It's a pleasure to be here.
So one of the big stock market trends has been the outperformance of mid-cap and small-cap companies over their large-cap peers. We've seen this strong performance out of ETFs that track these areas like ticker symbol TNA and MIDU. So what do you see here with the outperformance of these smaller stocks versus their larger peers? What's happening?
Yeah, what I think is really interesting here is this comes on the back of really decades of underperformance for small caps and mid caps relative to large caps. And of course, this was contrary to financial expectations where small caps are going to be riskier than large caps, but they're going to outperform. In fact, the performance of small caps was so bad that prominent investors and academics were basically coming out and saying, there's no small cap premium. It never existed. Trying to explain it away, even though there's decades and decades of history that says it exists. What I find quite interesting is just as the value stock relative to growth stocks that are to perform better for value post the Pfizer vaccine announcement in November, small caps really got that boost too, because most of their revenues are coming from more domestic sources as opposed to multinational companies that are larger in nature. And if we think about the comeback of the economy, it's really going to help a lot of these smaller companies first and foremost. So what we've seen is money really flow back into our leveraged Russell 2000 fund, TNA, which has had great performance in the back of that. So traders, both investors have been kind of allocating towards small cap, filling that hole in their portfolio, and traders have come back in a big way with our leveraged bull ETF, TNA.
I can't let you get away, Dave, without talking about inflation. It's been at the top of many investment minds, and we've seen higher inflation tick up. It's a bad sign for some industry sectors, but on the other hand, it's also been good for others. So how do we approach the inflation trade from a sector investing angle?
I think we have to listen to the Federal Reserve officials for the time being, but also respect the data. And what we're being told and what the data up until now may be telling us is it's transitory. So what that means is if you're a trader, you might actually have the ability to benefit really markedly from some of these big inflation prints that we're going to see. So of course, in this market, inflation beneficiaries first and foremost in the energy space. So we've seen our bull energy ETF do exceptionally well. Seen a lot of volume activity. Really actually seen that on the oil and gas side. So this is a more narrow focus, really at the kind of tip of the spear when it comes to inflation expectations. So that's been areas where we've seen people put some money to work. On the flip side, although we've continued to see inflows here, the higher growth tech sector, semiconductors continue to do well, even though they may actually not benefit as much from a higher inflationary environment. So again, time will tell. If you really believe into it, plenty of options to position portfolios there, but also some opportunities for some more nimble activity in the meantime.
Now, commodities have been another group that have benefited from higher inflation. The Direction Auspice Broad Commodity Strategy ETF, that's ticker symbol COM, C-O-M, has having a pretty strong year. So what do you see behind the hot performance in commodities?
Yeah, what's really interesting, of course, commodities broadly out of favor have come back in a really powerful way because of the supply and demand mismatches that we're seeing. What I think is really interesting about COM, which was a bit of an under the radar ETF for many years, but its strong performance has helped it kind of be propelled to the forefront. What that fund does differently than other strategies is it's actually a long flat strategy. So simply put, it can be long certain commodities if they're trending positively, but it actually won't own those that are not trending positively. So as opposed to just sticking with a commodities strategy that's going to give you the beta to all commodities, this fund is actually going to be more dynamic in nature and focus on the opportunities, because as we know, commodities is an asset class, but there's a big difference between sugar, lumber, and gold. So this fund kind of takes into account investor sentiment within the commodity complex to position the portfolio accordingly.
Now, the last time we chatted, Dave, you gave us a heads up, and thank you for doing that, about the rotation away from growth stocks into value. Now, at the time, growth was outperforming. You said, listen, keep an eye out on those value stocks. They're out of favor, but there's some things that are brewing that you might want to keep an eye on. And so we continue to see since then a real nice rebound in value stocks relative to growth. And actually, Direction has a pair of what's called relative weight ETFs that favor value stocks over growth, or vice versa, depending on your view. Value, of course, is winning in 2021. Does it continue?
Yeah, it's interesting. So our relative weight ETFs, RWVG, so that's value over growth, and then RWGV, that's growth over value, are 150-50 strategies. So what that does is it gives you a view, of course, on value or growth, but also amplifies that exposure. So it's 50% of more value in the case of RWVG, balanced with a short on growth. So its performance this year, as you'd imagine, has done exceptional. That's on the heels of pretty poor performance in 2020 when growth did well. But the point of the fund is to be able to have investors implement their view with greater precision and amplification. Here's what's interesting about value. If we look at the growth versus value valuation differential, still plenty of opportunity for value to run. In addition, we're beginning to see earnings estimates and EPS for value stocks, so I'm thinking financials and energy, start to actually catch up and in some cases outpace some of these growth sectors. So there's definitely some momentum on value. With that being said, the macro environment still remains mixed. And if we see a slowdown in vaccination rates, if we see a slowdown in economic activity, which maybe some are saying we're already starting to see because we're later cycle, then we might see growth come back in a big way. For the time being, I don't think anyone believes that both can do well at the same time, but that's actually a third point of view that could be the case. And that rising tide would lift all boats. And frankly, it would probably be a good sign for the market because we've been so bifurcated for such a long time.
One final thing before you take off: the recent pullback in growth stocks tied to clean energy, cloud computing, 3D printing has triggered lower prices, and really an opportunity to own some of these high growth companies at lower prices. You got the Moonshots Innovator ETF, ticker symbol MOON, which owns these types of companies. Tell us more.
Yeah, it's interesting. So Moonshot Innovators ETF had excellent performance, of course, in the back half of 2020, heading into 2021, has fallen off of its highs and has begun to kind of find a bottom here, but it's really focused on the 50 most innovative companies at their early stage. So all small to mid-cap companies across really a diverse range of industries, from 3D printing to autonomous vehicles to genetic engineering, that again are at the forefront of change. We identify these names with two ways. Both is a company's culture, focus on innovation. So we scan corporate filings if they're using words that historically in their industry have been focused on disruption and transformation. But we don't just focus on that. We actually see, are they walking the walk? So do they spend more on research and development relative to their peers? Combining those two things together can give you a really diverse basket of some of the most innovative companies. What I also think is interesting about Moonshot Innovators, a lot of these names folks might not be familiar with, but especially when we think about the top heaviness of the equity market, that might be a very good thing. So you're still going to have massive growth exposure, but you're going to do so without owning all the FANG names that probably represent most of people's strategies in today's portfolios.
We're going to have to leave it there. Thank you so much, Dave, for your insights. Keep up the good work.
Thank you.
Again, that was Dave Mazza at Direction Investments. I'm Ron DeLegge with ETF Guide. Don't forget to hit the subscribe button. Post your comments in the section below. Tell us how you've been enjoying our programming and today's episode. We've given you a lot of good ways to play the current market trend, along with helping you to reach your unique financial goals. We'll see you next time. Thanks for watching.